Welcome to the CLS Monthly Market Review. I'm Rusty Vandeman, Chief Investment Officer at CLS Investments, and with me this month is Grant Engelbart, Director of Research and Senior Portfolio Manager. Welcome, Grant.
Thanks for having me.
Well, we have a lot of ground to cover here. Let's see if we can do it in a fairly concise manner. So first of all, the markets this past month, as it seems like I say every month, another great month. As of this point, with hours to go with the month left, the U.S. market is up strongly. International markets are up, though lagging. Bond market, flattish, kind of the story we've seen so far this year, and the commodity market actually has actually outperformed bonds over the last year and year to date, but it depends what part of the commodity sector you're looking at. A lot of interesting things going on. One thing I want to bring in is, because you're an expert in a lot of different areas here at CLS, but one area is sentiment. And I like to talk about sentiment a lot. Of course, we have our podcast called The Weighing Machine, which is a play on how we invest money over the long term. Valuations and fundamentals win out. But over the shorter term, it's about emotions and kind of human emotion. So sentiment's really important for short-term market direction. You follow the sentiment. What is it saying, and what does that mean for portfolios in the markets?
Great question. So sentiment has a lot of predictive power over shorter time periods. So we think about valuations having a lot of predictive power over longer time periods. Sentiment really, as the famous quote inspires, drives markets in the short term. And it takes into account things like people's opinions, positioning of funds. So if everybody is long the dollar, it's hard for the dollar to continue to go up. Right. Things like that. So kind of looking through the landscape, the S&P 500 sentiment is in optimistic zone. It has been there about all year. And we started to creep higher into optimism. And so what that means is forward returns generally are a bit lower.
It seems counterintuitive at
it does.
First. Like everybody's bullish. How can the market be down in the next 12 months? But it's usually because the buying power has been exhausted, and usually expectations are so high that even if you get numbers that come in expectations, like what's the nudge higher? So the market becomes vulnerable, right?
And it's one of the big reasons I think the level of sentiment in the end of January was so high. It's one of the reasons I think we had that sell-off earlier in the year. We're not up there yet, but we're still in optimism. If you look at fixed income, it's been on the low end of the sentiment range. People are more bearish on fixed income, which is generally positive for its future returns. Couple other asset classes that are important is the U.S. dollar, we mentioned. Sentiment has been elevated, but it's just recently, just this week, ticked into what we call the neutral range, or it's coming off optimism. When that happens, that's when the dollar performs the worst going forward. So we think that's important because that's positive for commodities, it's positive for international securities, and a lot of our portfolios. So commodities on the other end of the spectrum, areas like gold and agriculture, very depressed level of sentiment, which is indicative of higher future returns.
That dollar sentiment thing is really a big churn of events, really. So, I mean, as you said, it suggests that international markets should start outperforming, commodities should start outperforming as well. Another thing, too, is fixed income. I always think that's fascinating, is that fixed income, if you're trading fixed income, and we're buy and hold users of fixed income, but when you look at the sentiment conditions, when people are really bullish or just neutral, fixed income is negative to flattish returns, but it has really attractive returns when people are really negative on bonds. Right. And not only does the sentiment, but you can see it in a lot of other measures, like right now, like there's massive short positions in treasuries, which is actually another contrarian signal as well.
Exactly.
Great stuff. Let's talk about our CLS investment themes. I mean, we're heading into the fall. The fall in the last 4 months of the year usually is pretty exciting in the markets. A lot of volatility happens. There's usually some really bad months, but quite frankly, it's usually a pretty strong time of the year. So either way, it's going to be fun, right? Yeah. But let's review our investment themes. We have 3 themes this year, and the 3 themes basically are be active, be smart, and be creative. So let's kind of review them, what they mean, and how they're performing for us this year. So first of all, be active. What is that for us?
Sure. We're active managers, so it's kind of goes without saying, but we also are emphasizing the use of actively managed funds and ETFs. Yeah. And we think that those add a lot of value, particularly in fixed income. There's more and more active equity ETFs coming to market that we think can offer a lot of value.
And I got a stat for you.
Sure.
So if you look at the industry of ETFs right now, and you look at the traditional market cap ETFs versus actively managed ETFs, and look at a 3-year time frame, and you break it out kind of in the major asset classes we do: domestic equity, international equity, fixed income, and then alternatives. And all 4 of those categories, the actively managed ETFs have outperformed the market cap ETFs. And I think actually ours have done well here at CLS.
They have. So we own a number of different active ETFs, a lot in the bond space. All of those have done well in the past year to date and 1 year time frame, outperformed their respective index. Then on the equity side too, we're expanding more into that, and a couple of our larger holdings have done quite well against their benchmarks there as well. So we're excited to continue to delve into the actively managed space.
So to summarize, be active. So be active means two things for us. One, we're active, so we're going to make tilts in the portfolio. Yep. That hasn't worked out because our two biggest tilts haven't worked. It's international over domestic and value stocks over growth. We still love both of those areas for prominent reasons. Value stocks are the cheapest they've been in decades, and international stocks are the cheapest they've also been in decades. So we like that positioning. Right. But the second thing is, as you mentioned, the use of actively managed ETFs, and that has added value to a portfolio this year.
And one more point on that too. We have portfolios of American funds as well. The average large cap manager out there in the universe this year there's been about 40% of them have outperformed the benchmarks. With American funds, it's closer to 2/3 of their funds have outperformed. So that's a
nugget I didn't even know yet. I had to listen to the video to hear that.
Yep.
Great, thanks. Okay, the second theme is smart beta, and that really goes to our emphasis of smart beta ETFs. And again, a smart beta ETF is basically taking a factor, and a factor basically is some sort of filter or screen that a human portfolio manager might use in building a portfolio. Takes that factor, creates a quantitative rule when you can build an ETF around it. So it's rules-based and systematic. Basically captures the essence of active management. There are studies say it captures 80%. Some say it captures all of the value of an active manager, but at a fraction of the cost. Depends on how you want to look at cost. Maybe it's 1/4 of the cost, 1/3 of the cost, 1/2 of the cost. Whatever it is, it's a good deal for investors. Right. Smart beta for this year, doing industry stats I just mentioned, smart beta over the last 3 years has outperformed, which is great, though not as much as sort of historical averages, but that's primarily because value hasn't been working in small caps, and those, up until recent at least, and those are really kind of the leading sort of smart beta factors. And for us, actually, it really hasn't helped because we've been emphasizing value as well so far this year. But nonetheless, we love smart beta. Historically, it's provided value of factors of 2% per year over the last 20 plus years. Our expectation isn't that, but we still believe it's going to give us an edge. The last one is another area of your specialty too, is be creative. What does that mean, and how do we articulate it?
Right, so be creative is our kind of third and final theme, and it's the use of commodities, real assets, liquid alternatives to diversify portfolios. So in a world of kind of low expected stock and bond returns, we think those asset classes make a lot of sense and should be a more prominent part of people's portfolios. So the correlation benefits there are huge. As markets ebb and flow, you want securities that are doing the opposite maybe of the rest of your portfolio. So there's kind of two halves of it. So there's commodities. I mentioned a bit earlier. Commodities had a great start to the year. Oil kind of rode the oil market higher. They've given a little bit back lately, but we've really shifted kind of away from oil and more towards some agriculture, gold, and some of those other commodities. We've written about that recently. You'll see that in portfolios. And then on the other side of the coin is the liquid alternative space. And this is a really wide area of expertise or wide asset class encompassing a lot of different strategies that kind of use other asset classes and combine them together. But the point is low correlations and kind of a return source you can't find anywhere else. And that's actually done well, right? Those are positive, not as much as large cap growth stocks are positive, but they're on a risk adjusted basis, they've done quite well. And if you compare them to fixed income, which is another area that you would be diversifying with, those securities have outperformed. So we think those both make a lot of sense going forward and are delivering kind of different returns and helping diversify portfolio's.
And I think they've added value to CLS portfolios. And one more little nugget, kind of tying back into actively managing smart beta. In the alternatives and particularly the commodities space, when you look at the smart beta and actively managed ETFs in that space, they've really trounced the market cap in all time frames. So again, that's another value add for us and for our portfolios.
And within the commodity space, I think two of the major products we're using are both actively managed, and we've seen that be positive for portfolios.
Well, thanks. I think we've covered a lot of ground.
Absolutely.
Thanks, Grant.
Thanks for being here.
And thank you for your time and trust in CLS Investments. We will see you next month.